Hello students, my name is Dr. Rajani Agrawalla and I am going to start the topic of capital and revenue expenditure and income. After that, I will also cover in this video insurance claim. Now, coming to what is capital expenditure and what is revenue expenditure. So, here you can see capital expenditure. The purchase of fixed asset used in production or research such as land, building, machinery, vehicles and equipments. These are known as capital expenditure. Actually, it is a heavy expenditure, the benefit of which we will utilize for more years, okay, more than 1 year. Like you can see the example, a company may spend money on machinery and equipment to increase its production capacity. Right, so here machine is a necessity to increase the production capacity, and investment in machinery is of a huge amount. So it is capital in nature and it will go to balance sheet. Now, suppose a company spend money on vehicles to transport goods from one place to another. Again, purchasing a vehicle is a heavy expenses and capital in nature, and we will utilize it for more than a year. Now, another example is a company spend money on office space which can be used for storage or a sales office. Again, it is just like constructing a shed or a new office building. So, this is also requires huge investment or huge expenses. So, it is capitalized. Now, coming to revenue expenditure. What is revenue expenditure? So, the purchase of product and services consumed or used during one financial year is known as revenue expenditure. Example, advertisement expenses, cost of goods sold, salary and wages, and rent expenses. All these are revenue in nature. Okay, so these are the expenses which should be during the one financial year. This is the basic difference. The expenses which are in the nature of and utilized or consumed or used within one financial year, this is revenue expenditure or revenue nature, maybe expenditure, maybe receipt. And in comparison to that, if any kind of expenditure made on assets to be utilized for more than 1 year, then it is capital expenditure. Now coming to next, what are the rules? What are the rules for determining the capital expenditure and revenue expenditure? So, the cost of acquiring a property or other asset is capital expenditure, whereas the revenue expenditure should be related to business of company. Sorry. Expenditure on repairs and maintenance of an asset is considered as capital expenditure, but revenue expenditure should not be capitalized. Then, expenditure on acquiring machinery, equipment and vehicle is capital, right? But revenue expenditure should not be recorded as an asset in balance sheet. This is the basic difference also, and these are the rules. What am I saying? Then, expenditure on intangible assets such as goodwill, patent, copyright are considered as capital, whereas revenue expenditure that company incurs to earn revenue should not be recorded as an expense or income statement unless they are one time or non-recurring. So these are the basic rules. Then coming to what is deferred revenue expenditure. Deferred revenue expenditure will not be used within the current accounting period, okay, but will be used in the future accounting period. Example, rent expenses for office space, interest expenses on loan, cost for repairs and maintenance. All these are deferred revenue expenditure. Okay, like it is there. Suppose it is expenses actually which is spread over different years. Okay, we do not use it or utilize it within 1 year. Right? Suppose we have made the expenditure on repairs and maintenance. Okay, we should not record it or record the entire cost in 1 year. If we will do so, then it will show us a heavy loss which will not be recovered immediately. That's why we use this deferred revenue expenditure in the balance sheet and spread this over several years, and utilize only part of this expenditure every year, so that we can proportionately give the or cover up the expenses. Okay. Now coming to the difference between capital revenue and deferred expenses. So coming to one, nature. Capital expenses is non-recurring in nature because it is non-repeating. We purchase it once. Revenue expenditure is recurring nature because it occurs again and again. Like that, deferred revenue expenditure is also non-recurring expenses. Then coming to purpose, to contribute to the revenue earning capacity of the business. The main purpose of capital expenditure is to contribute revenue earning capacity of the business, while the objective of revenue expenditure is to carry on day-to-day activity. And in comparison to that, the objective of deferred revenue expenditure is to get benefit for certain period. Then coming to period of benefit, the capital expenditure benefit is available for a longer period, while revenue expenditure is only for 1 year, and deferred revenue expenditure is for more than one accounting year. Right? Coming to effect on profit earning capacity. In capital expenditure, it increases the profit earning capacity of the business, but in revenue expenditure it maintains the profit earning capacity, and in deferred revenue expenditure it is of benefit to business for certain years. Then regarding accounting treatment, capital expenditure will appear on the asset side of the balance sheet, while revenue expenditure will be shown on the debit side of trading and PL account, depending on direct or indirect expense in nature. Coming to deferred revenue expenditure, the amount written off during the year is shown on the debit of the PL account, and unwritten portion will be shown on the asset side of the balance sheet as fictitious assets. Okay, fictitious assets are actually not assets; they are imaginary expenditures, imaginary assets, you can say. Because the name fictitious means imaginary. These they do not have any realizable value. Next, coming to capital expenditure accounting treatment. So the capital expenditure comprises of two accounts: the fixed asset account, which records the purchase price of fixed asset. Okay, the accumulated depreciation account records the depreciation expenses on fixed asset. The capital account is used to track the value of an asset and is also used to calculate the book value of the investment, whereas it is used on the income statement to reduce net income by calculating depreciation expense on fixed asset. So it can also be used as a credit on cash flow statement when it reflects an increase in the book of investment. So this is the treatment of the capital expenditure. Okay, coming to my next slide. Revenue expenditure treatment. So revenue expenditure treatment is a way to record the revenue and expense of the company for taxation. The method records all incomes and expenses items on the income statements are recorded in the financial statements. Now coming to my next slide. Conclusion. So conclusion regarding capital expenditure and revenue expenditure. So companies are not spending too much time on capital expenditure and not enough on revenue expenditure. Some companies spend too much time on capital expenditure and not on revenue expenditure. So it can be a problem of the company because they might have to take loan to cover this difference, which they cannot avoid, but which they should avoid, right? The fixed asset and accumulated depreciation account are subparts of the capital expenditure. Capital expenditure is mainly used for improving the value of asset and is also used to calculate the depreciated value of asset. The primary purpose of revenue expenditure is the process of taxation, and it is considered as a less value than capital expenditure. Now, coming to capital and revenue receipts. Just like expenditure, it is the opposite, named as receipt. It is our income side. So, what is capital receipt and what is revenue receipt? Capital receipts are the amount which occurs from sale of long-term investments or assets such as land, building, which are not the part of normal trading activities. Okay, suppose land, building, these are not the usual part of the normal activities. So, any sale of these assets is treated as capital receipts. Whereas, another example is capital receipts are payment for bigger item of expenditures, whereas revenue receipts are for day-to-day expenditures. Just like payments, it is the receipt. Means if it is a day-to-day expenditure, it is revenue receipt. But if there is a bigger expenditure, then it is a capital receipt. Now, what is revenue receipt? Revenue receipts are the amount from sale of normal trading activity or assets sale that will be replaced in the near future. So, the revenue receipts are the receipt of money because of the sale of goods, rendering services, and do not require the government to spend money. These receipts consists of revenue from taxes and non-tax revenues and grants and loans given by the government and the institutions. Okay, so basically they both are same, but one is expenses side and one is income side. Now coming to the next slide of example where you can clear your doubts, that is some example of capital receipts are when the sale of assets such as property, equipment is made, it is a capital receipt. Another example is loan from bank capital funding, loan payment. Capital receipts are typically not used in earning generation. Instead, the process are put in cash account to add the net worth of the business. Right? But coming to revenue receipt examples, sale of service or goods can be called revenue receipt. Revenue receipt example also includes sales invoices, tax invoices, cash memos. Then other examples may include donation, grants, penalties, fines, royalty, interest. These all are received for a short period of time and they are also within 1 year. So that is revenue receipts. And they are also known as operating income when they are earned as a part of company's main operation and is recorded on the income statement. Okay. Now, coming to my next slide, what is the difference between capital receipt and revenue receipt? So, coming to the source, capital receipt do not arise during normal course of business because it is capital in nature, but revenue receipts occurs in normal course of business. And the nature of capital receipt is capital in nature and it now treated as item of income of the business. But in contrary, revenue receipts are revenue in nature and will be treated in the income of the business. Then capital receipts are non-recurring in nature while revenue receipts are recurring in nature. And coming to the example, sale of fixed asset or raising of loan is an example of capital receipt, whereas sale of goods and services or rent from the tenant or dividend received, all these are the example of revenue receipts. Then coming to my next slide, conclusion, capital receipts results in the formation of new assets for the company and increases the net worth of the business. Revenue receipts are related to the current operation of the business and do not add long-term values of the company. So this is all about the capital and revenue introductory part. Now my next topic is insurance claim. What about the insurance claim? So let us start. regarding insurance claim. So what do you understand by insurance claim? It is a formal request from the policyholder to their insurance company asking for payment after a covered incident such as a hospital stay, a natural disaster or theft or anything. Basically we do insurance to suppress or to get rid of the risk involved on the stock, goods, anything. So there is a risk of fire, there is risk of theft, there is a risk of any event or incidents which are unforeseen. So to reduce the risk, we insure the goods. Okay, so even our life get insured. We can have the life insurance. So there are many kind of insurance. So now our topic is how to claim that insurance. Okay, so claiming is a formal request from the policyholder from the policyholder to the insurance company asking for payment, that I have given you money to keep it as the security so that in case of my bad time or bad incidents, I will recover or I will get back my money and I will recover my loss. So they make a request to the insurance company for the payment. This payment typically issued to the person named on the policy as the designated beneficiary. That helps to pay for the expenses associated with the covered incident. Insurance claims are a crucial aspect of risk management. This involves the process of notifying an insurance company for a covered loss and seeking compensation as per the terms of the policy. Understanding the interests of the insurance claim is essential for both the individual and the business point of view. So, now how many types of insurance are there? There are lots of insurance. There are vehicle insurance, there is health insurance, property insurance. Basically the insurance is divided into two parts, general insurance and life insurance. Life insurance is on the life of the person. So the money will be utilized by its beneficiary. Okay, after his death, the beneficiary will get the money. But the general insurance is to avoid the risk from the stock, like fire insurance, health insurance, motor vehicle insurance. Even now there is trending of event insurance. When a lot of expenditure is made on the marriage events, but at the end we came to know that the lady or the groom or the bride are not in the ready-made position to get married. So what happens? The marriage breaks there, but the expenditure made in the whole event get spoiled. So to recover this loss, one new insurance is now trending, that is event insurance. Okay, like that now jewelry insurance is coming up. The people spend their money on jewelry, especially the ladies or the girls. So, but they keep it in the home and they do not have any security or surety that it will remain safe. So if they will insure it, then even if it was theft or anything, then they can recover this amount from the insurance company, right? So this is the various type of insurance. There is also marine insurance. Okay, and so many insurance are there. Now coming to some important type of insurance, like vehicle insurance claim. Vehicle insurance claim differ in types such as accident, theft or damage due to natural disaster. It is crucial to understand the specific procedure and requirement for each type of claim, because there is home insurance, there is vehicle insurance, there is life insurance. Every claim procedure is different, and it should be claimed in proper manner as per the terms and conditions, and there will be a detailed investigation that it is due to natural or it is due to our negligence. After that, the insurance money is decided. So in case of health, it encompasses a wide range including hospitalization, medical expenses and reimbursement for prescribed treatment. So when we have any health issue and we have a health insurance, so we can recover the huge expenditure of that hospital bill through our insurance claim. Like that, there is property insurance. Property insurance claim covers damage to homes or commercial properties caused due to fire, natural disaster or theft. So all these insurance, all this situation necessitates specific evidences and assessment. After that, you can receive the claim. So like that, there are various types of insurance. Okay, it is not possible to cover all these in the PPT, but still overall I have make you understand that these are the types of insurance heavily demanded in the market. Now, coming to insurance policy of the business firm, one is property insurance. Property insurance provides coverage for physical assets such as building and equipment against theft, fire and natural disaster. Whereas liability insurance protects the business from legal claims due to third party bodily injury or property damage or related incidents. So nowadays business insurance is going on, like that liability insurance. Okay. Now business interruption insurance compensates for lost income and extra expenses incurred due to a business interruption caused by a covered peril. So these are the insurance policy of a business firm. So actually this chapter is not regarding the insurance, its types and all that. It is about insurance claim. How to, when to approach for insurance claim, how to approach, how to get there the money. This is all about insurance claim. So now let us come for the procedure for taking up insurance policy for loss of profit. So what is the process for taking up the insurance policy for loss of profit? First of all, evaluate the business operation. Analyze the revenue streams, cost structures and business processes to determine potential area of fragility. Right? After that, go for risk assessment. Evaluate the factors that could impact profit such as market condition, competition and internal vulnerabilities. Then you have to do policy selection and customization. Choose a policy that aligns with your specific risk profile and profit vulnerability of the business. Right? This is the correct procedure for taking up the policy. Now, what is the procedure to take up insurance policy for loss of profit, loss of stock? The previous slide was on the loss of profit. Now, how to take the insurance policy for loss of stock? First of all, go for inventory evaluation. Conduct a comprehensive assessment of the stock to determine its current value, vulnerability to damage and coverage requirements. Then do policy comparison. Compare and analyze different insurance policies to select the most suitable one for the specific nature and value of the stock. After that, go for documentation and compliance. Ensure meticulous documentation of stock details, including purchase record, inventory list and valuation reports to facilitate claim process. Now, coming to procedure to lodge insurance claim. One is notification. Notify the insurance claim promptly after a loss, providing all necessary details without delay. Okay, the first process to go for insurance claim is to notify them. Let them know that something happens and somebody wants to claim. After that, submit the evidence. Submit all the relevant evidence such as police report, photographs, witness statement to support the claim. After that, assess the claim. Means you have to go for claim assessment. Allow the insurance company to access the claim, which may involve inspection or evaluation by adjuster and specialists. So cooperate them for that. Then, what is about average clause and indemnity period? So, understanding the application of average clause is crucial as it directly impacts the proportion of loss that the insurer will cover. So, that is the average clause. And coming to indemnity period, knowing the indemnity period is also important as it specifies the duration for which the insurance company will compensate for the loss of business income. So, everything should be mentioned in the terms and conditions. So, before taking any insurance, you have to first read, then go for that. Choose various alternative. There are various alternative available. Choose the best policy which fits your demand. Accordingly, go, so that after that you should not repent. Then next, coming to my next slide. What is the process of ascertaining loss of stock and loss of profit? So, one is quantitative assessment, one is qualitative assessment. So, calculate the financial impact of the loss by quantifying the depreciated value of stock and the reduced profit margin. This is the best process to do the qualitative assessment, so that you can ascertain the loss. Then, undertake a qualitative assessment to analyze the non-financial ramification such as market reputation and consumer perception. So, these are also very important for the business. Okay. So, you have to also do the quality assessment regarding this to ascertain the actual loss in terms of quantity and in terms of quality, in terms of reputation, in terms of profit. Right. Now, coming to my next slide. This is ascertainment of claim against loss of stock and loss of profit. Okay, one is claim evaluation and one is claim settlement. As you can see in the board, thoroughly evaluate the documentation and evidence to ensure accurate assessment of the claim for loss of stock and profit. Okay, we have to evaluate the documentation and evidence properly, because sometimes the claimant do for his own benefit. Okay, they saw that it is an accident, but that accident is due to him only, or he tried for that accident so that the insurance claim can be received. So, first of all, we have to go for the detailed investigation and documentation evidence. Then, we have to settle the claim. Upon approval, the settlement process involves determining the compensation amount and ensuring disbursement within the stipulated time frame. After we are satisfied, after the insurance company is satisfied, they will finalize the amount of damage they can recover. They can cover for us, and also they will give a time period to disburse that amount. Right? So, here is the snapshot of the claiming evaluation type, and here is the claim settlement form. Right? So, basically, insurance claim, insurance is a very good thing, good way of protecting yourself from the risk. Okay, everything now is insured. Whenever we go to purchase a vehicle, first of all we have to insurance it, or else you will get, if you will move the vehicle in the road, upon the road without insuring it, then you know there is a huge penalty or fine of around 5,000 rupees per month. Okay, so at a time 5,000 rupees. So, which will next time, if there is no insurance, then it will come to 25,000. So, there are different rules in different countries, different states. So, some insurance were made compulsory, like vehicle insurance. Some are optional, but it is better to opt for the insurance because it is for our benefit. Then what is the benefit of the company then? So, see, there are 10 people who have done their jewelry insurance. Suppose, jewelry insurance, each jewelry, for each jewelry they are paying the premium of rupees 1000 per month. Okay, they have made the jewelry insurance for suppose 20 years. So just imagine how much money from these 10 ladies I have, being the insurance company, how much money I have got from these ladies as the premium. So is there any chance that all the 10 ladies jewelry will be lost or theft? No. But either they will not claim for the insurance because that jewelry is safe, and whatever premium I am receiving, that is my income, right? And if somebody jewelry is lost, then what will be the maximum amount? The money I have received from others, from that money I will give the portion to that lady only who have lost her jewelry. So that will still I will be in the benefit. So, and also we are in benefit that whenever we go for life insurance, like, so we don't know, death is uncertain whenever the death will come, but by doing the life insurance, we can't withdraw the money in between. So what the insurance company will do, they will take the amount and reinvest it to somewhere else, they or give loan to somebody and charge high interest from them, and accordingly that is the income for them. So insurance is nothing, it is a pure business to earn profit, but it is good from the point of view of insurance company because it the heavy margin is there, and from the point of customer or society also, to keep them safe from all these hazardous situations. So I hope you understand. Thank you.